with the Federal Home Loan Bank of Des Moines, and together with my colleagues on the Member Strategies team, we both work with our member financial institutions on developing balance sheet programs. Today, I'd like to review the whys and wherefores of the Symmetrical Prepayment Advance. It's an increasingly popular advance type that allows members to hedge and potentially monetize the prepayment value of an advance in rising rate environments. During the presentation, perhaps you might want to think of the eagle as a balance sheet. As a feather falls, another feather on the alternating side automatically falls to maintain balance. As you'll see, this natural phenomenon bears some similarities to effective usage of the Symmetrical Prepayment Advance. Some operational matters before we fly. All registrants will shortly be sent a link to the webinar presentation. The webinar has a chat feature, and on your sidebar, feel free to type in a question as we go along. Finally, we'll have several questions, and we'll poll our viewing audience throughout the presentation. Please cast your votes on the side panels as we will be measuring your thoughts as we go along. Our agenda today will cover an overview of the Symmetrical Prepayment Advance, including the mechanics, benefits, features, and pricing of the product. Then we will discuss a few uses and applications of the Symmetrical Advance for your institutions, specifically in the areas of funding loans and in hedging an investment portfolio. Finally, we should have some time at the end to tackle any questions that you may have. So before starting with a discussion of the features, structure, and benefits associated with the Symmetrical Advance, let's now begin with a question to assess how familiar the audience on the webinar is with this type of advance. I'm going to turn the gavel over to Scott Hofer, our friendly moderator, and also my colleague in Member Strategies. And we're going to launch a poll here, and it's a simple question. We're going to give you three options. Tick one of the three, please. Have you heard of the Symmetrical Prepayment Advance, but I have never used it? That's your first choice. Your second choice is, well, I've heard of the Symmetrical Prepayment Advance and have used it. Or third choice, have never heard of the Symmetrical Advance. And Scott, while you're tallying it up here, I think the observation on our end should be, I think that we're all in deep trouble if anyone responds that they have never heard of the Symmetrical Advance but have used it. We wouldn't want that at all. So let's open up the polls here for about 30 seconds and see what the audience experience and knowledge of the Symmetrical Advance might be. The polls are open. I think we're good. Okay. Do we have a verdict? Scott, what does it look like?
All right, I'll share the outcome here. It looks like about 49% have heard of the Symmetrical but never used it. 44% have never heard of the Symmetrical, and 7% have heard of the Symmetrical and are using it, or have used it.
It sounds like we have a very timely audience then. This is good. So, a little bit about the Symmetrical Advance. It's an advance that can not only fund a wide variety of your fixed rate assets, but it can also hedge the risk of deposit erosion and the effects of deposit disintermediation that can take place when interest rates do rise. The Symmetrical Prepayment Advance, it provides stable funding that is not rate sensitive, and it includes, this is interesting, a feature which allows you, the member, to monetize the value associated with rising rates and has positive impact when liabilities are on your balance sheet and rates rise. So in order to realize this value, members would need to prepay the advance prior to the contractual maturity of the advance, and that would allow for a prepayment credit to be paid should rates rise sufficiently enough, and we'll show you some very specific examples here in a sec. So here we are with the Symmetrical Prepayment Advance. As you can see on the slide, it's the only Des Moines Bank advance that allows you to monetize a below market liability should rates rise, we offer a version of the advance with no cap on the amount of the gain that can be monetized. It's going to function the same as a standard advance would otherwise. It's a $100,000 minimum. We currently price this symmetrical contractual feature relative to regular advances, depending on where it is on the maturity scale. It's currently between 1 and 11 basis points higher than posted rates, again based on term. And the range of maturities is offered from 1 year to 30 years. And why would you use such an advance? Well, here's some applications for your balance sheet. The symmetrical advance is good for serving as a funding or hedging tool for longer-term assets, such as mortgage loans. It's great, as I'll point out here, for hedging an investment portfolio. And it also can provide some margin protection and market value hedging without the complication of using derivatives. The symmetrical advance not only provides stable funding and desired interest rate hedging features, but it's also great for preserving margins. So let's get into the mechanics a little bit here of the symmetrical prepayment advance. And again, it allows you to recognize a gain when or should you prepay the advance in an interest rate environment that is higher than the rate environment that existed when the advance was originated. To realize, again, this monetary value, you need to prepay it prior to maturity. Presently, the price, as I mentioned, of the symmetrical's contractual feature is only in the range of 1 to 2 basis points above a standard, or let's call it an asymmetrical advance in rate, if you're looking inside of 5 years. When I refer to the term asymmetrical, we're talking about a normal term advance without the symmetrical feature. And a normal term advance would dictate that if rates were to rise, you would not have a contractual feature in that regular advance that would allow you to monetize if rates went up. That is, with a standard term advance, there's no ability to cash in the chips if rates rose. Above a certain rate level, we would only pay you back at par, even though there may be an intrinsic value in the below market coupon advance. The FHLB Des Moines symmetrical structure does not, again, constrain maximum termination gains. As an example, we would not limit a gain to a certain percentage of the prepaid advance principal balance. So let's look at the key features. We'll sum it up here. There's no cap on realized gains. Again, for instance, if rates rose and the inherent or intrinsic market value was, say, 20% above par, we would not restrict your monetary gain or cap it in any way, say, at 10% above par. You can customize an advance with a symmetrical feature, not just in the form of a fixed rate bullet advance, but you could do it as an amortizer or even as a forward settlement advance. And you remember the webinar that we did a few weeks ago for the forward settle. You can monetize a gain, as I mentioned, if rates are above a certain interest rate level. And you've got that spread versus the normal or asymmetrical advances that's pretty narrow, especially 5 years and in. As you'll see with benefits, you can protect an investment or a loan portfolio with the ability to monetize gains from potential rate increases. And we'll delve into a case study on this feature here in just a couple of minutes. Also, you can apply the symmetrical feature, as I mentioned, to the amortizer or forward settle. Ask us, and as we discussed during the August 15th term advance webinar that we did, we can easily customize a maturity, amortization, or forward settlement schedule to fit your and your customer's unique requirements. That's the key word here, is customization. We can do it. So when you're going to execute an advance with the FHLB Des Moines, a member always has the option to prepay it for a fee that is equal to the present value of the remaining cash flows expected to be received by us. In some situations, namely when interest rates have increased enough, there is no prepayment fee due by the member as the market value of the advance is well below current market conditions. And here again, I'm talking about a regular or an asymmetrical advance. As we illustrate in this chart, the symmetrical feature will let you, the member, collect the difference between the current market value of the advance and the original principal, assuming that the market value is less than the original principal. So as you can see here, in this scenario, it would involve a $10 million 5-year fixed rate advance. Let's say the rate is 2.07. That would represent a symmetrical feature that's only 1 basis point higher than a regular or an asymmetrical advance. In this instance, once rates rose by approximately 50%, as you can see there, above the original execution of the advance, then the market value of the advance would be, if there is such a word, let's call it monetizable, to the tune of $64,000. That would be your intrinsic value of the advance. If rates, on the other hand, were to go up by 100 basis points from the point of the advance origin, we would be talking about a monetizable advance of over $297,000, it looks like. So how might you apply that positive value of the liability? Well, it might come in handy if rising rates created paper losses, or AOCL, also known as negative AOCI, accumulated other comprehensive income in your investment portfolio. It could certainly come in handy there. So let's also look then at just a picture of the scale versus regular advances, again, 1 to 30 years. We have premiums to regular or asymmetrical advances. As I mentioned, they range currently between 1 and 11 basis points and expand with maturity. And inside of 7-year maturities, however, spreads are confined to 1 to 2 basis points. Here's an important caveat, and I should mention this, that symmetrical advance structures are not eligible for community investment or CIA advances that I talked about in the August 15 term advance webinar. So now let's put the microscope on and really look at symmetrical advances versus non-symmetrical advances. This chart illustrates the difference in prepayment fees or credits that are associated with a standard 5-year, $1 million bullet advance, let's say, and the same advance which would have a symmetrical add-on feature. So as this chart would demonstrate, fees associated with flat or down rate environments are highly correlated, as most terms carry only a 1 or 2 basis point increase to the advance rate to include in order to include the symmetrical feature. The meaningful difference occurs in an up rate environment. So again, that symmetrical feature is going to allow you to realize a gain that's composed of the difference between the current market value of the advance and the principal amount in these up rate environments. In this example on the chart, an instantaneous upward rate shock of 100 basis points relative to when the advance was originated would result in a credit to you upon principal prepayment of $45,875. You see that one? It's the top bar, third column from the end. And in the event of a 100 basis points down scenario, you'd see that conversely there would be a prepayment penalty that would be involved. In this case, it would be $38,691. You can see that again on the top bar there. That's the negative credit, if you will. So on each symmetrical advance that's outstanding, very easy. We can provide you with an estimated prepayment fee or credit amount based on instantaneous parallel rate moves. Every symmetrical advance, in fact, has a market value that is dependent on the level of prevailing interest rates. Just like any advance, you can go on eAdvantage, take a look at your advance position, and see that market value estimate that you can go ahead and access. So if we were going to look under the hood, a prepayment fee or a credit is based on, again, that present value of the advances cash flow that are discounted at our estimated cost of funds to the maturity or duration of that advance based on a forward rate curve that we have, plus any costs that we associate with terminating or hedging that advance transaction. So there's a lot of people have questions about methodology specifically on prepayment calculations, prepayment credits. We have published a lot on the subject. Talk to any of us in the member strategies team or your relationship manager. So this graph, it shows the lost value. We'll call the lost value represented in the yellow portion of the chart here, or the opportunity loss that would be associated with the difference between a regular or an asymmetrical advance and an advance with a symmetrical prepayment feature. Here we're using the example of a 5-year maturity under a rising rate environment. And the gray line that you see represents a standard 5-year advances prepayment fee or credit under varying rate movements. If you look at the green line is going to represent a 5-year advance with a symmetrical feature. So, as an example, under a rate rise of, let's say, 200 basis points, if you see it there, a $1 million notional advance would represent a $77,358 credit versus an asymmetrical or a regular advance which would not, in that rising rate environment of up 200, give you any credit at all. We'd pay you back at par with a smile. If interest rates, however, were to decline, a member would have to pay a fee to prepay in advance regardless of whether the symmetrical prepayment feature was in place. However, if rates were to rise again, that potential credit could be applied to an advance with a symmetrical prepayment feature and allow you to repay that advance at an amount below outstanding par value. So let's now spend a few minutes on how exactly you might want to apply the features of the symmetrical advance to developing some useful investment portfolio hedging strategies. And this is really the most commonplace application that we see our members use is hedging investment portfolios. And we'll take an interesting poll here in just a slide or two. But the symmetrical feature, it's a great piece of insurance, this time against the sale of your bond portfolio during rising rate environments, right? It's about liquidity. If your institution is in need of liquidity in a rising rate environment, you could potentially have to sell some securities at a loss. You don't want to do that. The regulators don't want you to do that. However, the symmetrical feature affords you the opportunity to potentially realize a gain if you were to prepay the advance at the same time, and that would, in theory, help offset at least a portion of your losses from a security sale. So virtually all of our members are concerned about the potential impact of rising rates on their investment portfolios. And so with that, we're going to do an audience poll. And it's going to go like this. Scott is getting ready over here. But there were two occasions. One occurred in 2013, and the other occurred in 2015. Many of you remember when the fixed income markets were unroiled by the so-called taper tantrums. Do you remember that? It was during this time the Federal Reserve just started hinting that its quantitative easing programs, as measured by its balance sheet reduction potential, rates rose. So here's the question for you all. During the taper tantrum periods of 2013 and 2015, did your regulators ever express concern over the potential paper losses or AOCL on your investment portfolio? And there are three possible answers. You can denote yes, you can denote no, or you can say, gee, I'm not sure because I wasn't around then. Okay, Scott.
Polling is open.
Polling is open, and we'll keep it open another 30 seconds or so if that can work.
About 80% voted.
About 80% voted, and we're going to close the poll in 5 seconds. How about that? All right.
All right. Polling is closed.
Scott, how are we looking? Did people have long memories? Were they challenged by their regulators, or was the subject ignored?
The most popular answer is no, with 58% responding no, and 29% comes in second as not sure.
Very interesting. Okay, so the challenge here, of course, is that you might be concerned about the impact of rising rates on the market value of your balance sheet, and you might want to look at the symmetrical funding vehicle as a mitigant for the paper losses on your fixed income investments. In fact, we have had discussions, the FHLB Des Moines, with the regulatory community at the state and federal levels, and they sort of get an aha moment here. Many of our members that we've spoken with during these taper tantrum periods did talk to us anecdotally about visits from regulators, and they played the what-if game. They said, okay, you have high durations here in your investment portfolio. It's 5 years. Let's do the math and see what the impact would be on AOCI. And if the impact is too severe, well, we're going to start looking at your capital ratios here. Well, a very nice element to add to this discussion would have been, well, now, wait a minute here. We have some intrinsic value on the right-hand side of the balance sheet that in a rising rate environment we could monetize at will. So that's an interesting element to add to the discussion. So let's run through a case study here. Let's consider a sample portfolio of 583 units of treasuries, agencies, and munis, and we'll sprinkle in maybe another 70 or so units of mortgage-backed securities. The portfolio has a pretty conservative, but it's a normal duration these days for our members. It's, let's call it 2.55 years. And when we model instantaneous parallel rate shocks, we can see that the market value loss that accumulates as rates rise, it's almost 20% deterioration if rates were to rise instantaneously by 300 basis points. This is exactly the phenomenon that I was talking about. This is what worries regulators about in terms of liquidity and capital. Let's also model the simultaneous impact, this time on the positive side, booking 175 units, let's say, in the form of a ladder of 2-year, 3-year, 4-year symmetrical advances. Let's see what happens on a blended basis here. In an up 300 basis point scenario, the detriment that's caused by rising rates is somewhat cushioned. While we're incrementally paying 11 basis points in net interest margin impact, we are recouping about 25% of the hit that we would otherwise take to tangible equity. Do you see that on the chart there? You've got the market value loss down to 14% instead of 19.66%. So the point of the exercise is it demonstrates the impact on both the investment portfolio and symmetrical prepayment advances in a rising rate environment. The losses in the investment portfolio will continue to increase the higher rates move, leading to substantial losses on the portfolio. But by implementing a laddered approach of symmetrical prepayment advances for a portion, and again, this was just a portion of the investment portfolio, you can see how one is able to limit the net impact as measured by tangible equity. So since the financial crisis that we had in 2008, depository institutions all over the district have experienced significant increases in liquidity and balance sheet growth. And much of the liquidity has been deployed in the form of securities. Anecdotally, we do hear many pockets in the district who say, gee, we would like to book more loans, but deposits are ample and the security portfolios are still, I think, quite robust. In fact, in looking at statistics since 2008, and these are national statistics, increases in security portfolios have accounted for 55% of bank balance sheet growth. And for those on the credit union side, it's accounted for about 25% of credit union balance sheet growth. And additionally, slack post-crisis loan demand and significant margin compression have caused a lot of our members to seek additional return by investing further out on the yield curve, right? Where a 2.5-year duration becomes a 5-year duration. So again, to shield risk-based capital from potential unrealized securities losses, it might be a good idea to look at the symmetrical prepayment feature. So I'm now going to show you a very typical exercise that we in member strategies of the FHLB Des Moines do with members on testing optimal symmetrical funding strategies. So we review various symmetrical advance ladders and we blend them into funding scenarios with deposits as we went through with the August 15 webinar. Again, the outputs are blended versus deposits only impacts on net interest income and market value under different interest rate shifts. So in this example, we're going to model a 50-50 deposit and a 1, 2, 3, 4, 5, 8 year symmetrical ladder on an investment portfolio that's just a little bit north of $100 million. And let's see what we get. Let's look at that stressed interest case up 300, and a blended funding strategy will show a net interest income figure that's about $156,000 better than funding the portfolio strictly with deposits. You can see there that under a blended situation with laddered symmetricals, we come up with 2.91 mil versus 2.75 mil. Now, market value deteriorates by about 2.14% in that instance under a deposits-only funding scenario. Should rates not change under net interest income measurement, you'd be better off by $829,000 under a deposits-only scenario with no market value change. So graphically, you can see the impact of the advantage to portfolio market value of a blended symmetrical advance approach under rising rates. With the dark line that you see here, it's the darker orange line representing the blending. And the lighter line, the yellow line here, in this case, is going to represent deposits only. So the bars, the histogram, shows that once we hit a rate shock of plus 300 basis points, we are also, not just in terms of market value, but also in terms of net interest income, we're better off with a blended strategy. Anyway, we can run a variety of combinations that are possible, and we throw the different combinations into our models. We can tweak the advanced ladders. These are just all kinds of examples. You know, in this particular case, we've got 5 symmetricals that represent some somewhat shorter durations, What do we get here? We get a scenario of lower funding duration yield, slightly less margin protection in a +1 to 300 compared to what I just showed you. But we can run through all of these. And again, we can customize your investment portfolio under multiple funding sources. What we do is we use such tools as ZM swap analytics, and we can optimize and analyze the trade-offs again between net interest income and market value under multiple and customized rate scenarios for you, not just the instantaneous and parallel, but we can do the gradual and such. So speak with your RM and let us have a look under the hood. Other applications, the symmetrical advance, it's just as applicable to the hedging of loan assets as it is with hedging an investment portfolio. It's good for that. If you look at a simple illustration of how symmetrical advance would impact the market value of an institution that would be dialing in mortgages. Here's a good example. The market value of equity in the symmetrical advance would increase, and it would offset the interest rate related losses on a portfolio of mortgages, as an example. This is just conceptual, not an actual model. So if your core deposit base increases or if your assets shrink, you could potentially harvest a gain on the extinguishment of term funding that you no longer might require. So let's look at funding conceptually a real estate loan. Perhaps it's a $15 million, 3.5%, 7-year, maybe 3.5% is low these days, but a 7-year commercial real estate loan that amortizes over a 15-year period with an advance ladder that's composed of 3 advances, 3, 5, 7-year. Let's say this laddered strategy would have allowed a member institution to initially fund 80% of the commercial real estate loan with FHLB bullet advances and another 20% out of the deposit base. You could say in this example that the weighted average cost of advances would be 1.82%, and the total interest expense would be $1,185,000 for the life of the advances. And initially, the weighted average spread, not the initial spread, but the weighted average spread for life would be 2.01%. And we could further assume in this case study a deposit cost of 50 basis points. Alternatively, if a member under this case wanted to use that symmetrical feature, and we still wanted to use that 80-20 proportion of advances to deposits, the difference would be, again, that the symmetrical feature would add an additional basis point to each advance, and that would in turn slightly increase the total interest expense over the life of the advance. So the additional basis point per advance doesn't have a lot of impact. It raises the weighted average cost of the laddered strategy to 1.83%, lowers the spread to 2%, and only increases the total interest expense by $6,600. So you've got a minimal additional cost to add the symmetrical feature that provides the rate protection, and you've got a bit more flexibility to prepay the advance and to monetize any value at some point in the future. And again, without that symmetrical feature, the advance behaves as any other fixed rate bullet advance would. It would be subject to any fee due and no prepayment fee credit if applicable. And as we illustrated just a second ago in the case of an investment portfolio, that symmetrical feature can potentially help recoup a portion of the interest that's lost due to the early prepayment of an asset, let's say. It's useful for that too. So once we input, and you've seen the blended funding approach that we do before, once we input the asset and funding characteristics and optimize funding duration combinations, we can assess net interest income or market value of equity under many different rate scenarios. As we discussed back on August 15, there's some value in appreciating the characteristics of duration certainty, right? Read advances, especially those with this symmetrical feature. And those that hold duration uncertainty, read those as deposits, which, don't get us wrong, have a great place as franchise value and as a frequent low cost of funds. So, like everything else, it's about moderation. There's a reason why it's called a balance sheet. And if the value of your mortgages, or for that matter, other income assets, were to deteriorate as a result of rising rates, there really is no reason why you should be denied the ability to monetize what could be an offsetting gain from a symmetrical advance. So really, to conclude, whether you're looking to hedge unwanted interest rate risk, or if you wanted to fund a fixed rate investment or a portfolio of longer term fixed rate residential or commercial mortgages, that symmetrical add-on feature is something that you might want to consider when you execute any eligible fixed rate or fixed rate amortizing advance, or even one with a forward settle feature. That opportunity cost of adding the symmetrical feature, as I hope we've pointed out, is a fraction of the total advance rate and does not demonstrably increase prepayment fees in a down rate environment. Alternatively, the symmetrical feature can be quite material if rates do rise sufficiently enough in some of these up interest rate scenarios. So with that, feel free to call the FHLB Des Moines Money Desk for information on executing a symmetrical prepayment advance. Engage with your relationship manager, or for that matter, me, Scott, or any other member of the strategies team to discuss how the symmetrical prepayment advance and its many applications might best serve your institution. And with that, we can certainly open up the floor to any questions.
So John, here we have one question. How are gains on the SPA prepayments booked? You want to answer? Go ahead on how the gains.
Yeah, it would be booked in much the same manner as an investment. A gain on sale, a gain on extinguishment.
Yeah, my understanding of the accounting, I mean, we don't necessarily opine on the accounting side of things. You'd still need to talk to your accountants on this question, but basically the advance would be paid back at par, and then your account would be credited for that difference. So it'd be similar to investment, as like John was stating.
And so a good offset once you prepaid. Scott, one other question came in, and our members saying, in the whole scheme of things, where would a symmetrical advance stand if I simply wanted to maintain my net margins and I didn't really expect rates to rise and I had a low duration investment portfolio? The question is a symmetrical advance structure still appropriate? I guess my answer to that would be, it depends. I guess it would depend on your level of rate sensitivity and the other hedges that are built into your balance sheet. But if you were exposed to a moderate to large rate rise, it may be a good idea. But if your best interest was suited by, as you said here, preserving your net margin, and if you're comfortable with upward rate risk, then you might want to otherwise fund via floating rate advances, or even if you were somewhat worried about future Fed moves and such, consider a floating rate advance, perhaps with a cap. Hope that answers it. Okay, whatever.
So John, one other question came in here. How is the gain impacted over time? For example, does the gain go down as the advance approaches maturity?
It depends on where. It is not an option. It is a contractual feature. So the main determinant of value for that symmetrical prepayment feature is going to be the relationship to where interest rates are when you extinguish the advance versus when the point of origin when you originated. You're in the money versus out the money. So it would not have the same exact characteristics as, say, a tradable option.
Okay. One thing I'd add to that is if anybody does have a question on at a point in time and what yield curves do and everything, we can run that through our groups internally and give you answers on whether it be in the money or out of the money. If you have any scenarios you want us to run, you can always email your relationship manager or the strategies group, and we can run that for you.
That's exactly right, Scott. Any pro forma what ifs we could essentially price out on a forward basis.
Mm-hmm.
Exactly. Okay. Any others?
So one other question here, John. Is there a time frame when the advance needs to be paid off?
Any time before maturity. Any time before maturity in order to get that prepayment credit. That's right.
Excellent.
Yep. Okay. Any others? All right. Well, Scott and I would like to thank you very much for listening in to this webinar on the Symmetrical Prepayment Advance. Please engage with us. Please ask us questions. And thanks very much. This is also the final in a series of 4 webinars: marginal cost, term advances, forward settle advance, and today's symmetrical. And all are recorded and available for your respective institutions. All right. Thanks very much for tuning in, and we'll all talk soon.